on board then Mahesh Patil. He's joining in, CIO, Aditya Birla Sun Life AMC. Hi, thanks so much for taking time out, Mahesh. Let's get in a sense as to what you're making of the fairly fragile global setup currently. Do you believe that if we were to see, the undertone of the market back home changing, that would largely be led by global events?
Yeah, good morning. So, yeah, you're right. I think in the last few weeks, we have seen that the outlook on the global has kind of deteriorated, some kind of a risk off. Again, primarily coming in from the fact that rates hike. Okay, there could be, one more rate hike, and interest rates still probably going up. So the risk to the US global markets, and especially the US, is very much there. Also, while up till now we've seen that the outlook on growth has been fairly stable, but I think if rates continue to remain higher for longer, and that's what the outlook looks like, I think you could see some downgrades, okay, to earnings growth globally, specifically coming into the next calendar year. So I think clearly, I think the risk clearly looks from the global side, and we have seen also commodity prices, especially oil, has in this context has moved up. So that also poses some additional risk, especially from the Indian point of view. But clearly, I think there is some amount of caution over here, and it looks to be that global markets is in a correction phase.
When do you think it will start impacting India? Because the bond yields are at 4.5%, 5%. Some would argue and say that why invest in India at all? I mean, you're taking underlying risk where you're getting 5% or short return in US debt.
Yeah, so I think you're right. I think the yields there are attractive, and in fact, it's a good time to actually be launching a fund actually to invest into the US bonds, right? Because that the risk reward does look attractive. But again, it's a question about really the opportunity cost, right? I mean, yeah, you can play that trade, okay, over the medium term, but I think money which will come into India would come in slightly from a longer term perspective. I think the fact is that in India, despite all the concerns, global concerns, I think we are still looking at a fairly reasonable kind of a growth outlook. Okay, we're not seeing any major challenges over there. Earnings growth also would be in the mid-teens, which is fairly good. So I think given that, and also I think the runway of growth for India, okay, looks to be much better. I mean, India offers the best kind of a market where you could see that runway of growth lasting for, say, many years. So I think that is what will draw global investors. But in the short term, I would agree. I mean, because of, and that's what you've seen in the last couple of weeks, or rather full this month till date, we have seen the FI outflows have been negative. So I think that trend can continue for some time. But long-term money, I think, would look to buy into the dips.
Right. Mahesh, in your portfolios, what is it that you've done from when we hit that all-time peak, pretty much start of the month, to the way we've eased off from there now, about a 3.5% dip just at an index level?
So, I mean, slightly trying to be a bit cautious. So, we have seen a sharp rally in many stocks in the last 6 to 8 months. So wherever stock, and again, some of them have driven purely because of liquid reasons, not necessarily any fundamental change in view. So booking some gains over there, trying to trim some of the exposures there where the run-up has been too sharp and say beyond our comfort levels. Apart from that, I think more recently, I think the mix towards mid-cap and small-cap in the portfolio, trying to cut down a bit. Again, depending on the fund mandate, and more towards large-cap, where the risk reward looks to be slightly better than, say, in the mid and small-cap. Though I would say the mid and small-cap from a, say, medium long-term perspective still looks good, but more stock-specific. And also probably some of the global plays, right, where the outlook, we have seen some rally again in the global stock because the global growth numbers got upgraded last month. But again, one would still be cautious over there. So some of the global linked sectors which have rallied recently, I think we're trying to take some gains over there. But and then trying to raise some amount of cash, but not too much, because we don't see that it's best time to really time the market over here, because our outlook on the market is still fairly positive from a medium-term perspective.
Okay. Mahesh, why are banks not participating?
Yeah, so that's been some kind of a, because banks, if you look at in terms of Earnings growth is fairly stable. I mean, we don't see any major setbacks over there. Also, the fact that interest rates are going to remain higher for longer, that means the concern which was there on the banking stocks because of when rate cut happens, you would probably see a NIM compression. So that is not likely to happen soon. So yeah, I think it's probably to do with the high ownership which is there, and especially not only domestic but for FIs also, and some of the leading banks, right, where we've seen the management change. I mean, the merger issues which is there. We've seen large amount of selling over there. So I think it's because of primarily being overowned and the fact that the best in terms of the interest and NIM margins is behind us. But that doesn't mean that the banks would see any major cut in earnings. They look fairly steady, and valuations are fairly okay. I mean, they are probably in line with the long-term average or slightly below that. So yeah, so I think it's more about sector rotation. I think other sectors where the growth outlook looks to be better, I think money has moved over there. But I would say the banks look fairly stable here. I mean, and also I think within the banks itself, we've seen some movement towards NBFCs, right? In the last 3 months, where the growth has been much better, and now in the margin expansion, okay, could likely play out as rates come down over there.
Are you being very selective when it comes to IT?
Yeah, so in the IT sector, again, good bounce back we've seen in the last couple of months. And while a lot of the large IT companies have been seeing good deal wins in the last quarter, and that has given some hope that while you might see next 1 or 2 quarters, which could be weaker, but I think next year, again, there could be some bounce back in terms of the growth looking at the deal pipeline. And also rupee has slightly been a depreciating more. So that's the reason why we've seen the IT sector do well. But again, within IT, I would agree that one has to look at companies which have got better execution capabilities or executing much better. Also, they're mixed in terms of which segments they are catering to, right? I think that will drive the, I mean, you will see far more differentiation in terms of growth for IT sector. There'll be few companies which will growing at around 12 to 15%, others will grow at around, say, 5% or so. I think so in that scenario, I think it will be important to really be more stock specific because you will see the tailwind across the board.
0.5% of Aurobindo Pharma, some of the pharma names are doing rather well for themselves. So Mahesh, what is the tactical trade for next 1 year or so? I mean, a year ago it was banks, it was buy banks, avoid IT. Suddenly banks underperforming, IT is coming back. While the macros are telling us that banks should do well, IT should do badly. So where do you think there's the interplay of both tactical as well as structural?
So I would say that, see, I think India growth, okay, and especially what's happening in India, right, both on the manufacturing side, on the investment side, I think that is going to be much more sustainable and structural. And that is driven by multiple factors, right? Both what we are doing internally also and what's happening globally, geopolitically, where countries are trying to move away from China. So I think that story, which has started to play out, I think looks to be far more sustainable. And in that context, and also the fact that we've seen India per consumption side, discretionary consumption has been weak. But India is now reaching a threshold of per capita GDP, which is crossing around $2,500, somewhere near that. So that will mean you will see a secular increase in terms of discretionary spend. And so I think these are some of the sectors where one would take us a more, I would not say tactical is very difficult to say because a lot of things will keep on changing. But these are sectors where one would take a slightly structural view. And any correction in these sectors, whether it is industrials, capital good, power sector itself. Sector also we've seen now, after a long time, we're seeing that the deficits in the power sector could increase, and capex both on the power and the coal as well as renewables is likely to pick up, and that will have a downstream impact on the other supplies also over there. Even real estate is looking fairly good and steady, despite the fact that interest rates have gone up. Probably cycle has started, and I think there is a reasonably good outlook which is going to be there, and we see that better execution from the larger players, consolidation industry. So some of these sectors, I think, and all these are more domestic facing. On the global facing, I think IT is a sector where we think that it's a good opportunity to really build exposure, because the current slowdown, what we are seeing, is more because of discretionary spend cuts. And I think the structural story in IT in terms of digital, right, spends toward digital, moving toward digital, and AI now again coming center stage, I think that sector could bounce back going forward. So IT could be a more counter-tactical trade to really buy in this recent slowdown.
Okay. On that note, Mahesh, great to have you on the show. Thank you so much, as always, for taking the time out.